Here is the bottom line before we go anywhere else. Nvidia announced at its GTC conference that CEO Jensen Huang is sitting on a $1 trillion order pipeline for Blackwell and Vera Rubin chips through 2027. That number is twice the size of what he projected at the same conference last year, and the stock barely moved. If you want to understand where Nvidia actually stands right now, that muted reaction is the most important data point in this entire story. Not the revenue figures, not the analyst upgrades, the silence. Let us talk about why that matters. Nvidia just posted fiscal fourth quarter 2026 revenue of $68.1 billion, up 73% year over year. Data center revenue alone came in at $62.3 billion, surging 75%. Net income reached $42.9 billion, rising 94%. Earnings per share climbed 98% to $1.76. For the full fiscal year, revenue jumped 65% to $215.9 billion. These are not good numbers. They are historically extraordinary numbers. And yet here we are, with the stock down nearly 4% year-to-date in 2026 as of this recording. The consensus interpretation is that Nvidia is simply priced for perfection, that the bar is so high that even a $1 trillion backlog lands like a shrug. And that reading is partially correct, but it is incomplete, and incomplete is where most investors lose money. The deeper truth is this: the market is not just repricing Nvidia's valuation, it is beginning to price in a structural question about the company's addressable market. And that question has a name. It is called China. Here is the point most people are glossing over, and this is where the story gets genuinely uncomfortable. Jensen Huang himself has said that China represented a $50 billion annual opportunity for Nvidia if the company could address it with competitive products. $50 billion. That is not a rounding error. That is roughly 3/4 of Nvidia's entire data center revenue from just 2 years ago. Right now, that market is effectively closed. The US government imposed export restrictions on high-end AI chips to China. Nvidia tried to navigate this with a downgraded chip variant, the H20, designed to meet export thresholds. But in a remarkable escalation, China then blocked imports of even those chips for a period before partially reopening. Meanwhile, during Nvidia's fiscal Q4 earnings call, CFO Colette Kress stated plainly that while small amounts of H200 products for China-based customers were approved by the US government, Nvidia has yet to generate any revenue from them, and the company has stopped including China in its forward guidance entirely. Let that land for a moment. The world's most valuable semiconductor company has removed its second largest potential market from its own financial projections. That is not a footnote. That is a structural hole in the growth story. And it is getting more complicated. Federal prosecutors recently charged 3 individuals, including a co-founder and senior vice president of Supermicro Computer, with conspiring to smuggle $2.5 billion worth of AI servers containing Nvidia CPUs into China. That enforcement action has not made Washington more sympathetic to loosening export rules. In fact, there are now Democratic lawmakers pushing to freeze Nvidia's existing export licenses in response. The political wind on this issue is not blowing in Nvidia's favor. Now, there is a scheduled meeting between President Trump and President Xi in May. Markets are watching it. And yes, some incremental diplomatic warming could nudge the needle. But here is what the optimistic scenario actually looks like at best. Not a restoration of free trade, but marginally less hostile posturing. China has already built its domestic AI stack. Alibaba is expanding data centers globally. Chinese AI chip companies are making progress. Colette Kress acknowledged during the earnings call that Chinese competitors have the potential to disrupt the global AI industry structure over the long term. That is a candid admission from inside the company. So if China is the wound, what is the armor?
The answer that Nvidia bulls give is CUDA, and they are not wrong. CUDA is Nvidia's software development platform, and it is the reason this story is more complex than a simple export control narrative. Virtually all of the foundational software in the AI industry was built on top of CUDA. Large language models, computer vision systems, scientific computing frameworks, the overwhelming majority of them are trained on Nvidia hardware because that is where the development ecosystem matured. Switching away from CUDA is not just a procurement decision. It is a multi-year re-engineering effort that most AI labs are simply not willing to undertake when they are racing to ship products. This is the structural moat that the bears consistently underestimate. Amazon, Microsoft, and Alphabet are all developing custom AI accelerators. AMD is pushing its Instinct GPU line, with Oracle committing to 50,000 MI450 units, and AMD announcing a joint venture with Cisco and Humane targeting a gigawatt of AI infrastructure by 2030. Broadcom is designing custom silicon for hyperscalers. These are real competitive developments, but displacing CUDA at scale is a different challenge than winning individual procurement contracts. The ecosystem lock-in is deep, and it was decades in the making. At the same time, the bulls consistently underestimate how fast the competitive environment is moving. Custom silicon does not need to replace Nvidia everywhere. It only needs to capture a meaningful slice of marginal demand. If hyperscalers run 40% of their workloads on their own chips instead of 30%, that is a real constraint on Nvidia's growth rate, even if CUDA dominance holds for training workloads. The two things can both be true simultaneously. So, where does this actually leave investors? Let us run the scenarios cleanly without pretending we know which one plays out. If US-China diplomatic progress in May is meaningful and export restrictions are incrementally relaxed, Nvidia's forward guidance begins to look conservative. The company has a $1 trillion order pipeline that was already built without China. Any China revenue would be incremental to projections that no longer include it. In that scenario, the stock's current valuation at roughly 22 times forward earnings starts to look like genuine value, particularly given that the forward earnings estimate from Wall Street currently sits around $7.66 per share, on approximately $369 billion in projected revenue. The upside path from here is not speculative. It is the reopening of a market that was arbitrarily closed. If export restrictions tighten further and the political climate after the chip smuggling prosecutions pushes Washington toward more aggressive controls, Nvidia's forward guidance may need to be rebuilt. Not because demand is softening, the infrastructure build-out among hyperscalers is real and ongoing, but because the addressable market ceiling becomes structurally lower than projected. In that scenario, competition from AMD and custom silicon matters more, because growth has to come entirely from markets where the battle is already contested. There is a third path that most analysts are not modeling explicitly, and it is the one worth watching most carefully. Nvidia is no longer just a chip company. The energy partnership announced during CERAWeek, building flexible AI factories that function as grid assets alongside AES, Constellation Energy, and NextAir Energy, is a material strategic expansion. The BioNemo pharmaceutical platform with Eli Lilly and Novo Nordisk is another. Jensen Huang's vision of agentic AI as the next demand inflection point, which he described during the earnings call, points toward a software and systems business layered on top of the GPU foundation. If that transition accelerates, Nvidia's revenue mix diversifies in ways that make it less vulnerable to any single geopolitical constraint. The Wells Fargo overweight rating reflects precisely this broader picture. Their thesis is not just GPU sales, it is Nvidia's expanding role in autonomous vehicles, healthcare, robotics, and AI infrastructure writ large. Here is the single line that captures where we are. A $1 trillion order pipeline that barely moved the stock is not a failure of the business. It is a market telling you that the next chapter of Nvidia's story depends on a $50 billion geopolitical question that Jensen Huang cannot answer from his GTC stage. The architecture is set. The demand is real. Whether the addressable market is $50 billion larger or $50 billion smaller is now being decided in diplomatic rooms, not data centers.